Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Tax Treaties and Totalization Agreements. Tax treaties and totalization agreements are critical tools in navigating global compensation and benefits, especially for human resource professionals managing international workforces. Understanding these agreements ensures compliance with international tax laws and social security regulations, thereby optimizing the financial well-being of both employees and employers. Tax treaties, also known as double tax agreements, are bilateral agreements between two countries that aim to avoid double taxation of income earned in both jurisdictions. These treaties are essential for multinational companies and expatriates because they delineate tax rights and obligations, thereby preventing the same income from being taxed by both the country of residence and the country of source. According to the Organization for Economic Cooperation and Development, which provides a model tax convention used as a basis for many DTAs, these treaties cover various types of income, including business profits, dividends, interest, royalties, and salaries. One of the primary mechanisms in tax treaties is the allocation of taxing rights. For instance, business profits are generally taxed only in the country where the business has a permanent establishment. Similarly, salaries and wages are typically taxed in the country where the employment is exercised unless specific conditions are met that allocate taxing rights to the resident country of the employee. This allocation is crucial for human resource professionals managing expatriates, as it affects payroll administration and the computation of net take-home pay. Totalization agreements, on the other hand, are bilateral treaties that coordinate the social security systems of two countries. These agreements are designed to eliminate dual social security taxation and fill gaps in benefits coverage for workers who divide their careers between two countries. The United States, for example, has totalization agreements with several countries, including Canada, Japan, and Germany, among others. These agreements ensure that workers do not pay Social Security taxes to both countries on the same earnings, and that they can combine periods of coverage under the Social Security systems of both countries to qualify for benefits. For instance, if a U.S. employee is sent on an assignment to Germany, the totalization agreement allows the employee to be exempt from German Social Security taxes and remain covered under the U.S. system, provided the assignment is temporary and does not exceed 5 years. This exemption is beneficial for both the employer, who avoids the administrative burden of dual contributions, and the employee, who maintains continuity in Social Security benefits. An essential aspect of tax treaties is the provision of relief from double taxation through the credit method or the exemption method. Under the credit method, the country of residence allows a tax credit for taxes paid in the source country. For example, if a U.S. expatriate pays income tax in the host country, the U.S. will provide a foreign tax credit to prevent double taxation. The exemption method, on the other hand, exempts the income taxed in the source country from taxation in the resident country. These provisions necessitate meticulous record-keeping and tax planning to maximize tax benefits and ensure compliance. The OECD's Base Erosion and Profit Shifting Initiative has introduced significant changes to international tax rules affecting tax treaties. The BEPS Action Plan includes measures to prevent tax avoidance strategies that exploit gaps in tax rules to shift profits to low or no tax locations. For instance, Action 6 of the BEPS Plan addresses treaty abuse by introducing a principal purpose test that denies treaty benefits if one of the principal purposes of a transaction is to obtain those benefits improperly. This has implications for structuring international assignments and requires HR professionals to be vigilant about the substance and purpose of cross-border arrangements. Tax treaties also include provisions for the exchange of information between tax authorities, enhancing transparency and cooperation in tax matters. This exchange helps combat tax evasion and ensures that taxpayers accurately report their global income. For HR professionals, this means that compliance with tax reporting requirements in both home and host countries is paramount, and failure to comply can result in penalties and reputational damage for the company. Totalization agreements also address the issue of Social Security coverage for dependent family members accompanying the worker. These agreements typically ensure that family members are covered under the Social Security system of the worker's home country, which can be crucial for healthcare and other benefits. For instance, under the U.S.-Canada Totalization Agreement, family members accompanying a U.S. worker on assignment in Canada remain covered under the U.S. Social Security system. This continuity in coverage is essential for the well-being of employees and their families, reducing the stress and complexity associated with international assignments. Statistics on the utilization of tax treaties and totalization agreements underscore their importance. According to the OECD, over 3,000 tax treaties are in force worldwide, facilitating cross-border trade and investment by providing clarity and stability in tax matters. Similarly, the U.S. Social Security Administration reports that totalization agreements have prevented billions of dollars in dual Social Security taxation and have facilitated the payment of benefits to thousands of workers who have divided their careers between countries. Real-world examples illustrate the practical application of these agreements. Consider a multinational corporation with employees working in various countries. Without tax treaties, these employees could face significant double taxation, reducing their net income and creating dissatisfaction. For instance, a U.S. employee working in the United Kingdom would be subject to U.K. income tax on their earnings and U.S. tax on the same income. However, the U.S.-UK tax treaty mitigates this by allowing the employee to claim a foreign tax credit for UK taxes paid against their U.S. tax liability. This coordination ensures the employee's overall tax burden is minimized, enhancing their financial well-being and satisfaction. Another example involves a U.S. company sending an employee to Germany for a 3-year assignment. Under the U.S.-Germany Totalization Agreement, the employee remains covered under the U.S. Social Security system, avoiding German Social Security contributions. This arrangement simplifies the administrative burden for the employer and ensures that the employee's Social Security benefits are not disrupted, providing peace of mind and continuity in retirement planning. In conclusion, tax treaties and totalization agreements are indispensable tools for managing global compensation and benefits. They prevent double taxation, ensure Social Security coverage, and facilitate international mobility by providing clarity and stability in tax and Social Security matters. HR professionals must be well-versed in these agreements to optimize financial outcomes for their companies and employees, ensuring compliance with international regulations and enhancing the overall expatriate experience. The strategic utilization of these agreements not only supports the financial well-being of employees, but also contributes to the operational efficiency and global competitiveness of multinational corporations. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UXL, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.